You know what kills me? Watching a contractor get a $200,000 draw, smile like they just won the lottery, and then spend it like it's all theirs. Only to discover 3 weeks later they can't make payroll because the subs are banging on their door and the materials aren't paid for. That's not a revenue problem, that's a setup problem. And if you're trying to implement Profit First for your construction company the same way a coffee shop would, you're building on wet concrete. It won't hold. Here's the thing about construction cash. It doesn't behave like normal business cash. You deliver work first, then maybe you get paid 45 to 90 days later if the client doesn't find some excuse to delay or withhold. It's backwards. You're financing your customer's project with your cash, your credit, and your sanity. And yet most contractors set up Profit First like they're running a retail shop where money comes in before it goes out. The problem isn't the Profit First framework, it's treating construction money like it's all spendable the moment it hits the bank. So today we're walking through the most common and most expensive mistakes contractors make when setting up Profit First for contractors and how to fix them before they cost you payroll, profit, or worse. Let me be clear, this isn't theory. These are mistakes I've watched contractors make for 30 years as a CPA. The ones that turn a good framework into a cash disaster because they skip the construction specific setup. Let's start with a big one. You get that $200,000 draw I mentioned. All of it lands in your checking account. And your brain says, we made $200,000 this week. Except you didn't.
Because $140,000 of that money is already promised to subs, materials, bonds, permits, and job-specific labor. That money isn't yours. It belongs to the job. You're just the middleman. Let's scribble this out. Total deposit, $200,000 minus subs and materials, $100,000 minus job-specific labor, $30,000 minus bonds, permits, rentals, $10,000 real revenue, $60,000, that's it. That's your actual revenue for allocation purposes. $60,000, not $200,000. This is the foundation of Profit First for commercial construction. You calculate real revenue the construction way by subtracting JobEx needs first. Everything that exists because of this specific job, subs, materials, job-by-job field labor, equipment rentals, bonds, permits, that's JobEx. It goes into a separate account and it gets funded before OpEx, before payroll, before profit. JobEx is sacred. It funds the current job's direct costs, period. Get that discipline locked in at the bank account level and you stop the bleed before it starts.
Second mistake, using the target allocation percentages straight out of the original Profit First book without adjusting for construction reality.
A software company with predictable monthly revenue can use those percentages just fine. But you're a general contractor sitting on 10% retainage with 45-day payment approval cycles. Or you're a roofer working in a seasonal market where half your revenue comes in 4 months. Your cash behavior is completely different, so your allocation percentages better reflect that. Here's the fix. If you've got heavy retainage exposure, you need higher JobEx buffers. If you've got long AR cycles, you need to moderate your OpEx targets so you're not choking when clients pay slow. If you're seasonal, you need bigger tax reserves and cash cushions to ride the valleys. The principle is simple. Your bucket should match your trade's cash timing, not some generic revenue tier chart designed for businesses that don't finance construction projects.
Here's where contractors tie themselves in knots. Is payroll JobEx or OpEx? The answer is, it depends. And the test is dead simple.
Ask yourself, does this cost exist only because of this specific job? If yes, it's JobEx. If no, it's OpEx. Field labor example. You've got a concrete crew you call up project by project? That's JobEx. You've got a site superintendent on salary year-round, whether you have work or not? That's OpEx. Equipment rental example. 3-month skid steer rental for a specific project? JobEx. 36-month truck note that you're paying regardless? OpEx. Misclassify it, and your real revenue looks prettier than it really is. Your jobs run short faster than a short dog's legs, and your gross margin stays hidden until the project's over and it's too late to fix.
This one will absolutely wreck you. Treating retainage like it's available cash.
The client withholds 10% on a $500,000 job. That's $50,000 sitting in restricted limbo. But you spend it on payroll, overhead, maybe a new piece of equipment. Because it's earned, we'll get it eventually. Then project closeout hits. And guess what? That $50,000 you already spent, you need it now to close out the job, pay final retainage to subs, Handle punch list items. You're broke at the finish line. The fix is simple. Segregate retainage in a dedicated reserve account the moment it's withheld. Do not allocate it to profit, OpEx, payroll, or anywhere else. It stays locked until the client releases it. Only released retainage flows into your normal buckets. This forces you to operate on actual available cash, and it shows you real quick when retainage policy is strangling your cash position. Better to know now than discover it when you're trying to close a job with an empty account.
Here's a sneaky one that trips up custom builders and specialty trades: customer deposits.
Client gives you $60,000 upfront for windows and cabinets. Money lands in your operating account. Payroll comes due. You borrow from that deposit to cover it. Then the supplier calls ready to order, and oops, the money's gone. That's not just bad discipline. That's legal exposure. Those deposits create obligations. If the client demands proof the money went to their job and you can't show it, you're in a world of hurt. The fix: hold customer deposits in a separate job deposits liability account. Think of it like an escrow holding pen. Money goes in, sits there untouched, and only gets released when you place the actual purchase order for those long lead materials. Then you've got a clean audit trail tying deposit to purchase to invoice to job completion.
So, how do you actually set this up right?
You create construction-specific bank accounts that match how construction cash actually behaves. JobEx account funds all direct job costs: subs, materials, job-by-job labor, rentals, bonds, permits. Gets funded first before anything else. Payroll account, separate from OpEx, funded weekly or bi-weekly on a strict rhythm. Your crews get paid on time because that bucket is protected. Owner's compensation account, separate from employee payroll, funded on the same rhythm. Treats the owner's pay like the business expense it is, not leftover scraps. Profit account, quarterly distributions aligned to project milestones like substantial completion or retainage release, not arbitrary calendar dates. Tax account, standard, no surprises there. OpEx account, overhead only, no job costs, no payroll, no rating it for equipment purchases. Retainage reserve, protected, restricted, untouched until released. Job deposits, liability, escrow for customer prepayments. And here's the behavioral magic. When you enforce these rules at the bank account level, your habits change automatically. Money lands, it goes to the right bucket by rule, and you stop making emotional spending decisions based on whatever balance looks biggest that day. You also shift your allocation rhythm. Original Profit First says, allocate on the 10th and 25th. That's fine for a law office. But if you run weekly payroll, you allocate weekly, every Wednesday, for example, to top off payroll, JobEx, and tax before your Friday runs. Match the rhythm to reality, and the buckets stay healthy. Fight the rhythm, and you're constantly scrambling.
You know what happens on a job site when foundation's wrong? Every wall you build on top of it is out of plumb. Every finish you tried to hang is crooked. And eventually the whole thing comes down or costs twice as much to fix. Same thing here.
Get the cash set up wrong, wrong accounts, wrong allocations, wrong classifications, and every other decision you make is built on bad information. You think you're profitable when you're not. You think overhead's affordable when it's bleeding you dry. You think jobs are funded when they're starving. Get it right and the rest follows. Your pricing gets honest because you're forced to see real gross margin. Your overhead expectations match what the business can actually afford. Your payroll's protected. Your profit's real. This isn't accounting, it's survival. And the beautiful part, once the system's set up right, it runs itself. The buckets teach you what the business actually costs to operate. The math follows the discipline, not the other way around.
So here's what I want you to do. If you're tired of guessing, tired of cash crunches, tired of working 60-hour weeks, and wondering why there's never anything left over, grab a copy of Profit First for Commercial Construction on Amazon. It's not theory, it's the step-by-step playbook for setting up these accounts, calculating real revenue, and making the system work in the real world of retainage, pay apps, and slow-paying clients. Or if you want help getting it set up right the first time, head over to ProfitFirstConstruction.com and book a strategy call with our team. We specialize in this. Profit First for contractors, not generic small business advice. We walk you through the setup, tune your target allocation percentage to your trade, and make sure your cash rules match your cash reality. And if you got value out of this video, do me a favor, hit that subscribe button and the bell so you don't miss the next one. We put this straight talk construction cash flow content out every week. No fluff, No theory, just practical systems that work. Because you didn't get into construction to become an accountant. But if you're going to stay in it and actually make money, you better get your cash system right. Thanks for watching. I'm Wade Carpenter, and I'll see you in the next one.